Most people don't realize this, but the next global economic shock will not announce itself with breaking news, flashing headlines, or dramatic countdowns. It will arrive quietly, slowly, almost politely, while everyday life continues as normal. Gas stations will stay open, grocery shelves will still look full, markets may even rally for a while. And that is exactly why so many people will be unprepared. Because the most dangerous economic crises don't begin with panic, they begin with silence. If you stay with me for the next few minutes, you'll understand why the global economy is standing on fragile ground, what signals most people are missing, and how this affects your money, your job, and your future. This is not fear, this is awareness. Before we go deeper, take a moment to like this video and subscribe to the channel Finance and Global Economy. It helps this content reach more people who want clarity instead of noise, and it tells the algorithm that calm, fact-based economic discussions matter. You'll also want to stay connected, because the shifts we discuss here don't happen once. They unfold over time. For decades, the global economy was built on one powerful assumption. Growth would always come back stronger after every slowdown. Recessions were seen as temporary setbacks, like storms that pass and leave the sky clearer than before. Central banks would cut interest rates, governments would spend more, and consumers would return with confidence. That cycle worked for a long time. But what if that cycle is breaking? What if the tools that once fixed recessions are now part of the problem? Look around the world today. Growth is slowing across multiple major economies at the same time. Debt levels are higher than ever, not just in developing nations, but in the strongest economies on Earth. Governments owe trillions, corporations rely on cheap borrowing to survive, and households are stretched thin. When interest rates rise to fight inflation, something breaks. When rates fall to save growth, inflation quietly returns. This is not a normal cycle anymore, it's a trap. Global instability is no longer a distant concept. It's visible in supply chains that snap under pressure, in currencies that weaken overnight, and in markets that react violently to a single policy sentence. Trade relationships that once felt permanent are being rewritten. Nations are prioritizing self-protection over cooperation. This creates a world where economic shocks spread faster and recoveries take longer. Recessions used to be regional. A slowdown in one country could be offset by growth somewhere else. Today, the world is deeply interconnected. A factory shutdown in one region affects prices across continents. A banking issue in one country tightens credit globally. When everything is connected, instability doesn't stay contained. It travels. One of the most misunderstood aspects of modern recessions is timing. Many people expect a crash to look dramatic. Markets collapsing, unemployment surging overnight, headlines screaming disaster. But modern economic downturns often move slowly at first. Job markets stay strong longer than expected. Stock markets fluctuate but don't fully break. This creates a false sense of security. People assume the danger has passed when in reality it's only beginning. Inflation plays a silent role in this story. Even when prices stop rising rapidly, the damage is already done. Higher costs change behavior. Consumers buy less. Businesses cut expansion plans. Governments face higher borrowing costs. The economy doesn't collapse. It slowly tightens, like a knot being pulled tighter over time. Another trend shaping global crises is demographic pressure. Many major economies are aging. Fewer workers are supporting more retirees. Productivity growth is slowing. This makes it harder to grow out of debt and easier to fall into stagnation. Younger generations face higher living costs, lower job security, and less faith in traditional economic promises. That loss of confidence matters more than numbers on a chart. Financial markets reflect this tension. Volatility is no longer an exception. It's becoming the norm. Investors move quickly, chasing safety one moment and risk the next. Long-term planning becomes difficult when the future feels uncertain. This instability doesn't just affect traders. It affects pensions, savings, and everyday financial decisions. What makes this moment different from past crises is that there is no clear reset button. After previous downturns, interest rates could fall sharply. Debt levels were manageable. Global cooperation was stronger. Today, policymakers face limits. Cutting rates risks inflation. Spending more increases debt. Tightening too much risks recession. Every option has consequences. And yet, life goes on. People still go to work, plan vacations, and scroll past economic headlines without stopping. That's human nature. But awareness changes outcomes. Those who understand macro trends don't panic. They prepare. They make better decisions, avoid emotional reactions, and focus on resilience rather than prediction. This channel, Finance and Global Economy, exists for that reason. Not to tell you exactly what will happen next, but to help you understand the forces shaping the world so you're not caught off guard when conditions change. As we move forward, global economic instability will likely come in waves, not one dramatic event. Short recoveries followed by new pressures. Market rallies that feel convincing, then fade. Policy announcements that buy time, not solutions. The danger is not collapse. The danger is complacency. If this perspective resonates with you, stay engaged. Near the end of this video, I'd really like to hear your thoughts, because these trends affect everyone differently depending on where they live and how they earn. The most powerful shift happening right now is psychological. Confidence in systems is weakening. People question whether hard work alone guarantees stability. Businesses hesitate before investing. Governments struggle to maintain trust. When confidence fades, economies slow, even without a visible crisis. History shows that major economic changes are rarely obvious in the moment. They make sense only in hindsight. Years later, people say the signs were everywhere. The real question is whether we notice them now. We are entering a period where global growth may be lower, volatility higher, and stability less predictable. This doesn't mean disaster is inevitable. It means adaptability matters more than ever. Understanding macro trends is no longer optional. It's essential. As we approach the end of this video, I want you to think about one simple question. Are you reacting to headlines, or are you understanding patterns? Because patterns shape outcomes, not noise. If you found this discussion valuable, share this video with someone who wants to understand the global economy without hype or fear. And let me know in the comments how you see the global economy changing from your perspective. Your insights help shape future conversations here. Thank you for watching, for staying engaged, and for being part of the finance and global economy community.